You.
Good afternoon, everyone. Thank you for joining. So today we'll be doing a webinar for understanding small case, the entire product, and how you can choose your small case, right? So today I have with me Anugrah Srivastav from Small Case. He's a co-founder of Small Case, and he will be taking over. So over to you, Anugrah. You can get started.
Thanks a lot, Nikhil. Very good afternoon, everyone, and thank you so much for joining us on a weekend. It's awesome to see so many of you joining us for today's session. Now, in today's session, broadly, we would be covering following 3 points. First is what is a small case? That is the concept behind the platform and how it is executed. The second is where and how one should invest their hard-earned money. And the third is how a small case is built. So let's directly jump into the session and first start with what is a small case. Now, small case is an equity investment platform which is specifically designed for retail investors. And it's a combination of the two of the best investing approaches, that is thematic investing and portfolio investing. As a result of the combination of these two approaches, you see products like affordable housing, growth and income, and a small case infra tracker on our platform. We would be talking more about these products and different types of small cases in the webinars to come. But the important point on this slide is that a small case platform combines two of the most important investment approaches, that is thematic and portfolio. Now let's move forward and understand what is thematic investing. Now, thematic investing is an art of investing in changes that you see on a daily basis around you. Now, if you ask me, for me, every change represents an investment opportunity. But the most important thing which retail investors are not aware of is how to capitalize on these opportunities. Now, thematic investing makes these opportunities very relatable and ensures that you are able to invest into them. So, thematic investing can be thought of as a combination of three things. First is observation, second is experience, and third is changes and developments around you. Now, let's take each of them one by one and understand what could be the example of that thing. Now, first, let's talk about the experience. So, experience means the things and environment that you are experiencing around you. For example, you might be experiencing that like increasingly people are becoming more brand conscious. You might see that your friends and family, they have become more brand conscious. They want to buy branded product. So you would want to invest in such a change. When I say that you would want to invest in such a change, is that you would want to invest in companies which will be able to capitalize on these changes by creating strong brands and making some profit out of it. For this, we have a small case called brand value on our platform. So this is an example of experience, that whatever changes you are experiencing around yourself, you are able to invest into them. Now, second is the observation. You might observe some changes around you in the form of new infrastructure developments that is happening in the city. Probably a new metro project has been recently launched. Now, all this could be a part of a smart cities campaign which is announced by the government. So this could be an example of observational investment, where you observe changes happening around you, which could be related to some policy announcement, and you invest into them. Again, when I say invest into them, it's about investing into companies which could benefit from these changes. So for example, if you want to invest into smart cities, a small case which is available on our platform, it would be to invest into companies which are grabbing projects announced by government related to smart cities. And the third form could be the developments or announcements that is happening. So recently, in the union budget, a finance minister gave infrastructure status to the affordable housing projects. Now, this could be an example of investing into recent announcements or developments. Now, you can find a small case related to affordable housing on our platform. So this is how you can actually think about thematic investing. That is investing into observations, experiences, new developments, and changes around you. Now, how our platform helps you is that we make all these changes very relatable and easy to understand for you. The next benefit of thematic investing is that it's intuitively forward looking. Now, countless studies have proved that historical returns never guarantee any future good performance. That is, if you see that a particular stock has given you a return of 50% last year, you might have read it in Economic Times or on Money Control, and you decide to invest into this stock, then Again and again, studies have proved that this is not something which works. You cannot base your investments on the historical performance of some stocks or some other asset classes. But the beauty of thematic investing is that it is forward looking. That is, you are investing in changes around you which can materialize into future scenarios which could become very profitable for certain companies. Now, you can see some of example of some of the small cases on our platform on the slide. For example, we have a small case called Bringing the Bling. It consists of companies which are catering to the emerging luxury market in India. We are seeing that income levels across the country is going up. People are spending more on luxury items. So if you want to take benefit of such a change, you need to go and invest into this small case. The second is Incredible India. This is a set of companies which will gain from India's rising popularity as a tourist destination. We see that government is again and again taking new initiatives, launching new advertisement campaigns branded around Incredible India. So if you feel that travel will increase, more foreign tourists will come, and India will gain more popularity as a tourist destination, then this is a sort of a small case where you should invest into. Now, rising rural demand is a small case which we'll keep talking about during the whole presentation. So I will skip it for the time being. So now that it is clear what is thematic investing, let's understand what is portfolio investing. Now, portfolio investing is about investing into and managing a bunch of stocks together rather than individual stocks. Now, let's try to understand it with an example. Now, last year, at the end of last year, government announced the demonetization drive. Now, a lot of newspapers were talking the benefits that it can have for banking sector stocks. Now, suppose if a retail investor picks up any newspaper and sees that, okay, this could be beneficial for banking system as a whole or banking stocks because a lot of liquidity has been injected into the system, and he goes ahead and buy Bank of Baroda's stock, thinking that, okay, this is a bank which has received a lot of money, so let me put my investment into it. Now, what happened recently is that Bank of Baroda's stock actually crashed more than 10% on 13th of February when it announced its quarterly result. So what went wrong here? You saw something happening. Actually, you read about it in newspapers. You went ahead and invested into a stock, but it tanked. The problem was that you didn't diversify stock specific risk. Your intent was to take an exposure into the banking system, but the way you executed it was not correct. Now, portfolio investing is a science which can actually solve this problem. Now, if you would have invested into a well diversified portfolio of banking stocks, you could have easily avoided this problem. It might have happened that at the same time, Punjab National Bank, when announced its earning, it actually went up a lot by like 5 to 6%. So these sort of changes in different stocks in your portfolio could offset each other. So when you're doing or when you're investing on a portfolio basis, you actually diversify away stock specific risk. That is, your any changes or new developments which are happening specifically with a particular company and not with the theme or idea you bought into can be diversified away. So that's the first and most obvious benefit of portfolio investing. Now, second is that it is a systematic investment approach. There is a well-defined weighing scheme. There is a well-defined rebalancing schedule. So it gives a systematic model to your investment approach. Everything is happening at a particular time, and you don't have to keep on worrying about when I should invest or do I need to sell a particular stock, do I need to buy a particular stock, because everything is well structured and predefined. The third benefit of portfolio investing is that it's very effective and it improves your decision making process. Now, let's say you were not investing into a particular idea, you liked 5 stocks, you made a portfolio of it and bought it through your broker. Now, if you're not tracking it on a portfolio basis, what might happen is that if one of the stock tanks 10% or 15%, it's a normal tendency that you might end up selling that stock. Now, on the face of it, it might look that, okay, you're actually selling a stock which is not making money for you, but this is not the right way of investing. You had created a portfolio, and when you sold that stock, you forget that stock was providing the necessary diversification into the portfolio. So your portfolio as a whole might be 2% up because one stock was down 10%, the another stock was up more than 15% or anything like that. But you end up selling individual stocks when you're not tracking or rebalancing on a portfolio level. So portfolio investing, the first benefit is diversify away stock specific risk. It's a very systematic approach, and at the same time, when you're tracking and rebalancing on a portfolio level, it improves your decision making process. Now let's come back to the small case. When like we have now understood what is thematic investing, what is portfolio investing. So let's talk about a small case. Now a small case platform combines these two approaches and creates the products which are very easy to understand, which are relatable, and gives to you in a very cost efficient manner. So on our platform you can find themes which are executed in the form of portfolios. Now let's understand this with an example. So as you mentioned, rising rural demand. So it's a small case which has been present on our platform since last year. We have highlighted this small case numerous times in our post weeks related to various developments. But let's see what happened very recently and then relate it with the small case, and at the same time try to understand various parameters which you can see on a small case page. Now, in the recently announced union budget, government announced many soaps for the agriculture and rural sector. Now, I have listed down three of them. That total allocation to the rural and agriculture sector was increased by 24%. It was also the highest ever allocation of 48,000 crore to Mahatma Gandhi National Rural Employment Scheme. And at the same time, agriculture credit target was also increased to rupees 10 lakh crore. Now, all these things combined together will definitely or is expected to result in increased rural expenditure or rural demand. Now, the theme or the thematic part of this small case that if somebody is interested in buying into is that he believes that because of these changes in future there will be a scenario when there will be an increase in the rural demand, and he wants to capitalize on this. Now the portfolio angle of this is that he is executing this theme in the form of stocks or a portfolio of stocks of the companies which have high rural exposure and thus are expected to benefit out of it. So this is what is a small case. It's a combination of a theme, which is the expected increase in rural demand in this case, and the portfolio investment approach, which is a bunch of up to 20 stocks which have high rural exposure and can benefit from this theme. Now, let's quickly try to understand few of the things that you also see on our platform. So, for rising rural demand in small case, you see that there is an index value. Now, index value shows the returns the small case has generated since it's been launched. Now, as you can see that the current index value is 268.22. So it represents that since the launch of the small case, it has generated a return of 168.22%. Because at the launch of a small case, the index starts from 100. So if you see the index is at 105, it means the small case is up 5% since its launch. If you see the index is 305, it means that the small case is up 205% since its launch. At the same time, you can also see the returns small case generated in last 1 year. The rural demand gave like a stellar return of what 46.88% last 1 year. In last 1 month also, it is up 6.59%. On the small case page, you can also see how the small case has been performing and compare it with the broader market, which is Nifty in this case, to understand whether you are actually able to generate some outperformance or not. We will talk more about different types of small cases, how the decision should be taken, or which small case is preferred or like is good for you. All this you would be covering in the coming webinars. Now, given that we have understand what is a small case and the thematic and portfolio angle of it, now let's just focus on the second point that we highlighted at the beginning of the session. That is where and how one should invest their money. Now, the first graph that you see uh, is basically a representation of annualized returns generated by different asset classes in last 2 decades. That is between a period of 1995 to 2015. Now, the green bar that you see is for equities. A value of 13.33 here represents that on an average, every year, equities gave you a return of 13.33% in the last 2 decades. Now, this is much better compared to any other asset class where generally retail investors park their money. You can see that real estate has generated a return of 8.08%. Provident fund, where a lot of people invest their money, has given a return of 8.93%. So, and You might see that the period of the study is from 1995 to 2015, but in last 1 year again the markets have performed well, so study would have actually, or the equities outperformance would have actually increased. Now somebody can point out and say that why have you chosen this period of 1995 to 2015, and they might say that the equities might be very low at 1995, so if you want to compare it with current level you will say that, oh, there is a very high uh, percentage return that the asset class has generated. To further uh, investigate into this issue, what we have done is that uh, we have calculated the average return generated by each asset class for different holding periods. Now this can be seen in the second graph on the right side. Now let's understand the first green bar for the 5-year holding period. Now it represents the average return generated by equities for a holding period of 5 years. So the first period would be 1995 to 2000, second would be 1996 to 2001, third would be 1997 to 2002, and the last would be 2010 to 2015. So overall there would be 16 such periods, and this number which you see a little more than 100% is an average of all these 16 periods. So it means that irrespective of the year that you get into the equities, if you hold equities for a period of 5 years, you generally end up doubling your money. That is, you get a return of 100%, and it is much more than any other asset class. Now, similarly, if you see the green bar at the end, which is for the 10-year holding period, it means there were 11 such periods. The first period was from 1995 to 2005. Second period was from 1996 to 2006, and the last period was from 2005 to 2015. So this green bar for 10-year holding period is an average of 11 such periods. And you see that if you are actually investing for long term and you invested for a period of 10 year, equity easily beats all the other asset classes, and you could have generated a return of more than 350%. So if so these two charts can make it very easy for any retail investor that where to invest your money. If you have some idle cash which you want to invest in there and you want to do it for long term, there is no better option compared to equities, and it has been proven time and again by countless number of studies. Now once we have established that where one should park their money, now let's look at how you should invest into equities, because there are different number of options and instruments which are available into market using which you can invest into equity markets. Now on this slide we compare the small case platform with the popular other equity instruments or options through which you can invest into a stock market. Now let's look at them one by one and compare it with the small case platform. The first option, which is on the right side, is the single stocks. Now, single stocks is one of the most difficult investment options for retail investors, because first, you don't have the sufficient knowledge or the pool of knowledge which can be accessed to build the understanding about this stock. So it becomes very, very difficult for an retail investors to actually find out different sorts of data and management commentary available for a particular stock and make the decision. The second, which we also talked about while we were talking about portfolio investing, is that risk is very high. That is, you're not diversifying the stock specific risk. Now, if we compare it on the basis of points that I have listed here, is that you are not investing into any particular idea, which or through in the form of a portfolio. So, a small case platform is course way above single stocks. You can actually customize the small case, that is, you can add or buy securities in a portfolio. That option is not available in single stocks because it's just one unit. There is no customization happening there. There is definitely no diversification benefits, and there is no support provided to you in the form of a fixed rebalancing schedule or a fixed weighing scheme and things like that. Now let's look at the one which is on the left side, that is the ETFs. Now, ETF is an equity instrument using which you can get exposure to any index. So suppose you want to you invest into an ETF with whose mandate is to replicate the performance of Nifty. That is, you are investing into a Nifty ETF. So if in last year Nifty generated a return of, let's say, 10%, the ETF should also generate a return close to 10%. So when you're buying into an ETF, you're basically buying into, or you're betting on the returns generated by the index which it is tracking. Now it obviously comes with a cost. There is a management fee which the ETFs charge. So if the Nifty has generated a return of 10% and there is an ETF which is charging an expense ratio of 1%, your returns is expected to be below 9% in that case. So again, there is no direct ownership of portfolio. That is, portfolio is not sitting into your demat stocks. It is not related with an idea. It is not at all customizable. There is no support in the form of rebalancing and trading. So again, small case platform clearly scores well above ETFs. Now let's consider the mutual fund, which is the most popular form of equity investment by retail investors right now. So like ETFs, mutual funds also charge an expense ratio. uh, Actually, let's talk more about it in the second slide that we have here, along with an example. So in last 1 year, if you see, the rising rural demand case has generated a return of 46.88%. Now, if somebody had invested into such a theme, so there is a mutual fund called Sundaram Rural India Mutual Fund, which generated a return of 45.84% in last 1 year. But the problem is that the expense ratio of Sundaram Rural India Mutual Fund is 2.72%. Now, on an average in India, expense ratio of equity mutual fund is around 2.5%. Now, this number might sound very low, but it can actually impact your returns by a huge margin if you are investing for a long period of time. To explain this in more detail, I have put a chart here. Suppose if you invest 50,000 rupees today and hold it for next 30 years, and you assume that on an average every year your investments are growing at the rate of 12%, then what will happen? The first line, which is the red line at the top, is the ideal world scenario where there are no taxes, no costs, nothing is there which can hinder the performance of your investment. So at the end of the 30 year, your 50,000 rupees will convert into somewhere close to 15 lakh rupees. Now suppose you do the same thing with a small case platform. That is, you pick a small case, something like rising rural demand, and invest 50,000 rupees into it. Now, there will be costs, and we will talk more about it just after this example. But ultimately, at the end of 30 years, you will still have a money of around 14.5 lakh rupees. Now, you see that okay, there's a difference of around a little more than 50,000 rupees. But just to clarify, right now, this 50,000 rupees doesn't come to a small case. Almost 99% of it goes to the different regulatory bodies in the form of taxes and transaction costs. A small case as a platform charges a flat fee of 100 rupees. So when you put 50,000 rupees into a small case, we get 100 rupees and we don't charge anything else. If you want to invest more, if you want to rebalance, if you want to add a stock, drop a stock, you never pay anything to a small case. But there will be other transactions and charges like stamp duty or SEBI transaction fee or service taxes, which you might have to pay. So because of this, ultimately at the end of 30 years, you will have a corpus of around 14.2 lakh rupees. Now look at what happens with the mutual fund. So at the end of 30 years, you will not even have 7 lakh rupees, which is like close to 50%. Now, this 2.5% number, which sounded very low when we were just talking about it and not looking at what happens 30 years down the line, this actually results into a corpus loss of more than 50%. So 2.5 year, every irrespective of the fact that your mutual fund manager is making money for you or not, you every year you end up paying 2.5% of your corpus. So initially you would have paid 2.5% of 50,000, but let's say 15 years down the line, when you had around 4 lakh rupees, you would pay 2.5% of 4 lakh rupees. So this cost keeps on increasing. So it keeps on eating into the returns that your investments are generating. So, as I mentioned, on an average, there is a 2.5% of expense ratio on all equity mutual funds. So, irrespective of any equity mutual fund, where you're putting your money, if you're putting it for a period of more than 30 years, and you assume that equity will give you a return of around 12%, you will lose more than 50% of your corpus. And I'm pretty sure none of us wants that. So, I don't think I need to say, but small case platform clearly scores well above mutual funds as far as costs and other things are concerned. Now, given that we have established where one should invest their money, how it should invest their money, and have understand the basic concept of a small case, let's come to the point where we discuss how we build a small case. So it's a very scientific approach that we follow at a small case, and it's a 5 step process for building a small case. Let's look at each of the step uh, one by one. The first is defining the universe. So when we are building a small case, let's take the example of rising rural demand only. If we are building rising rural demand in small case, we would look at all the 1700 stocks that are listed on National Stock Exchange of India. So it's not like we are looking only at some set of stocks, 100 or top 200 set of stocks. We would actually look at all the stocks, which is more than 1700 listed on the National Stock Exchange. So that's the starting point for any small case. The second is the research that goes behind into the small case. So we have a dedicated research team which has like very good understanding and the previous experience of building thematic portfolio indices for institutions at various investment banks and firms like Nomura and Thomson Reuters. So the team picks up the theme, let's say rising rural demand. uh, Modi government came up, they announced some soaps which because of which we expect an increase in rural demand. So from there the process starts. So there will be a lot of internal presentations that will happen inside the team before deciding whether this theme is worthy enough of putting on the platform or not. Now once the team decides that okay, this is, or the changes that have recently happened can actually pan into a future scenario which can result into profitable companies, that's where we lock a particular theme. Now, the next step is that research team identifies the sectors which could benefit from a particular theme. So, and at the same time, we also establish the companies which are pure plays in these sectors. So basically, you might say that FMCGs have a very high exposure to rural India. So you should, all the stocks belonging to FMCG could be considered for building a small case, but that's not true. Some of the FMCG companies might not be actually focusing on rural sector. So again, the research team identifies the sectors and the pure plays, that is the stocks which perfectly fits into the themes. Now, after this step, that is at the end of second step, is the where the manual intervention from the research team stops and our models take over. Now, stock screening, weighing, rebalancing, everything happens through the models that we have built. Now, let's talk about the stock screening. So, research team will give the input of sectors and pure play stocks to the models, and then model will automatically take care of different criteria to select the best stocks for you. Now, these criteria ranges from liquidity, momentum, technical indicators, fundamental indicators, future growth prospects, like a set of more than 15 criteria that our models look into and finally give you a list of stocks which could be put, which sort of is the best set of stocks for getting exposure to a particular theme. Again, the weighing is also done by our models, and one of the very important things that we take care of while deciding the weighing scheme of a small case is that at the end of it, it should be investable. If I come up with a weighing scheme where I ask you to invest 5 lakh rupees, I don't see a point of it, because when we say that we have built this platform specifically for retail investors, it's our job to ensure that they put out a product which is actually investable. That is, the retail investors have the capacity of investing into a product. So, along with looking into the pure plays or the expected profit from a particular theme, we also look at whether the small case will be investable after a particular weighing scheme or not. And our models take care of it very well. Because of which you see a lot of low cost small cases on our platform. And the last step is the rebalancing. In case of rebalancing, it's not like that we again only look at the stocks which we identified last time. We rerun the whole process from defining the universe to research, stock screening, and weighing. The whole process is rerun, because what might have happened is that some stocks might have got listed, there might have been a fundamental shift because of this recent announcement by the governments, or on the basis of which the small case was formed. So we take care of all these things again, rerun the whole process to again select the stocks which continues reflecting that theme. So this is how a small case is generated. These were the basic points that I wanted to cover in this webinar, but I would also like to answer a few of the questions that we received when during the course of interaction. And the first question was about the fees. As I mentioned on the last slide also, a small case charges a flat fee of 100 rupees whenever you buy a small case. That is, if you invest 50,000 rupees in rising rural demand small case, we charge a flat fee of 100. If you invest 5 lakh rupees, we again charge 100 rupees. If you invest 5,000, we still charge you 100 rupees. If you want to invest more, that is, you have invested 50,000, but 6 months down the line you feel that your small case is performing very well and you want to invest 50,000 more into it, we don't charge anything. If We keep on sending the rebalance updates also on a quarterly basis. So if you see that there is a rebalance update on your small case which says that you can drop 5 stocks and add 5 stocks, and you actually execute it, again we don't charge anything on it. So it's just a flat fee of 100 rupees for investing into a small case for lifetime. The another question that we received was whether you can customize or create your own small cases. So the customize option is up on the platform. You can go on the small case page, select the stocks and weights tab, and then there you can see the customize option. So before buying into any small case, if you want to add few stocks, if you want to drop few stocks, you want to check out the list of stocks which are related to the small case theme, that's where you go directly. Now the create option is coming very soon. We would be launching it in a course of probably next month's time. Another well requested option, requested option is systematic investment plan for small cases. So we are working on it. It's in the pipeline. It'll be coming up very soon. So before leaving, I would like to quickly tell what all we would be covering in the next webinar. So in this webinar, we have understand the concept of a small case and how a small case is built. We would taking up from here only where we are leaving. We would discuss the different types of a small cases. We would discuss how the process of discovering a small case, or how you can find a small case which best suits your investment ideology or your investment objectives. That's what we would be trying to cover in the next webinar. That's it from my side. Thanks a lot.
Thank you, Anugrah. That was quite a session. So, if you guys have any other queries, we've already shared a link to a post on Trading Q&A where you can ask all of these queries pertaining to small case, and the guys at small case here, I guess, will be answering them actively, right?
Definitely.
Okay. So, I guess that's about it. Thank you for tuning in on a Saturday, and we're off.